Well, the last few Fed meetings were boring, so why go hawkish now? Jay Powell broke the market, but way before now, and even before COVID. Let me tell you a brief story of his decisions. Let's see if you can spot a pattern. Now, when Jerome Powell was first appointed as the chairman of the Federal Reserve in 2018, he pledged to continue the tightening policy. The rate was 2.5%, and the balance sheet was $4.5 trillion. Now, Powell said he would bring the balance below $3 trillion. Now, 2018 didn't work out too well for the markets. The January crash welcomed the new chairman. Then, the autumn of 2018 brought SPX down by 25%. And Mr. Powell got scared and made a U-turn. Now, let me picture 2018 to the experienced audience that you are. A 50-year record low unemployment, 10 years of straight economic growth, and the pace accelerating to 4% quarter over quarter in autumn 2018. National debt below 100% of GDP and a reasonable rate of interest payments at 2.5%. Inflation was above the long-term target of 2%, sitting at 2.3 to 2.7% throughout the year. Now, as you can see, there was absolutely no need in stopping the tightening. The targets weren't reached. The balance sheet went down by only a half of what was promised. So in 2019, the first rate decrease marked this complete switch from fundamental economy to the printing addiction. COVID crisis reaction was only the consequence of this. The foundations were laid back in 2018. Now, of course, Powell had a great teacher in Ben Bernanke and his famous helicopter money policy, but Bernanke had a reason for that. He was tackling the financial crisis. Powell was just a rabbit in the headlights, and that's what he still is. Now, he was following Trump's will in 2018 to 2021. Then he switched to serve Congress. Hence, his obsession with inflation. He didn't care that it was above the target in 2018, but he cared about stock prices. Now, it's vice versa. But how bad can it be? Have a look at the immediate market reaction. Yes, I know SPX went down by almost 3% in 2 days, but here's the end game. Now, October bearish bets show quite a bit of speculative accumulations at $360 and $355 SPY levels, but pay attention. The support at $420 was strengthening too. January expectations seem more straightforward. While the $420 support is still there, it looks significantly weaker compared to the $410 and $400 downside targets with a combined notional volume of $9.3 billion. Now, that setup is barely changed in principle from the early August research we provided in the scenarios video. And by the way, SPY data is completely free on our platform. Check in the link in the description. So, having pictured the decision-making process of the chairman of the Federal Reserve Board of Directors, what have we really learned last Wednesday? Please subscribe to the channel because we are about to cover quite a few strategic trends. And yes, the Apple video is on the way. Next week, we will talk in depth about how the company is stuck between the growth and value camps and how this affects their strategy. Now back to Powell. Now, first takeaway is short-termism. The FOMC has no idea what is going on. They hide behind the "we watch the data" narrative to avoid any strategic talks. Jerome Powell says the rates are not coming down anytime soon, but the truth is he has no idea. A sudden U-turn is as likely as our next bullet point. Second, inflation addiction. Being consistent and persistence is a good thing, but Powell is simply stubborn. The difference is having a clear idea. Now, this inflationary spike had nothing to do with demand. It was always supply-driven. First, the supply chain problems during lockdowns, then geopolitical tensions. CPI reached 3.2% last month and went back up to 3.7% this month for one sole reason: oil prices. Well, let me tell you this. The Federal Reserve rate has absolutely zero influence over the OPEC Plus supply decisions. Inability to understand this simple fact leads us to point number 3. Jerome Powell said that a soft landing was no longer the basic scenario for the economy. What? They've been telling us that no recession is expected and a soft landing is almost guaranteed for 12 months. This is so much like the inflation narrative. Just listen to this evolution of claims.
That suggests that inflation is going to be higher this year, and the inflation rates for next year and 2023 were also marked up, but just by a couple of tenths. Much consistent with the view that these are factors that will wane over time, and that inflation will then move down toward our goals, and we'll be monitoring that carefully. Of course, we're prepared to use our tools as appropriate if that turns out not to be the case, to guide inflation to 2%.
Now it's the same with recession. And as you know, macro trends take time to unravel. It took the economy 2 years to recover from the 2008 financial crisis with all the monetary support. Same for the 2001 dot-com bubble and the COVID crisis. Even if they U-turn on the next FOMC meeting, the damage has already been done. It will get worse before it gets better. But they don't see the data, right? It will definitely be too late when they do. And that is point number 4. The full effect is yet to come. Jerome Powell said it, but did he understand what he was saying? The momentum will drag all the macro indicators for a while now. Now, my favorite example is debt. I'll talk about it in point number 5. But the other crucial thing is employment. If companies start to cut costs, those programs will take several months to execute. To turn it around, they'll have to see a spike in demand first. So to register this and to make sure it's not temporary, any noticeable size business will need at least several months. Then the hiring process, voila, 6 to 9 months before the numbers start picking up. Monetary policy is not a switch to turn the lights on and off. The FOMC seems to ignore this fact and keeps pushing. Now here comes the 5th point. We are in an era of high rates for quite some time. Current expectations show that the next 12-month average rate will be 5.1%, up from the 4.6% expected earlier. In 2025, we'll have 3.9%, 2026, 2.9%. Now, the national debt has just surpassed $33 trillion. The mortgage debt is roughly $18 trillion, and the corporate debt is around $20 trillion. Now, this pile of debt is now paying an extra 5% compared to 2021 and will do so in the next 12 months. That is $3.5 trillion wiped out of budget income, savings, personal income, and corporate profits. Now, in 2025, it will go down to $2.7 trillion, but that's a combined $6 trillion of burnt wealth. Who will fund this? Now, the key takeaway is this. Prepare yourself. There is still time to be fully ready. Now, stay on the safe side with Visual Sectors. Visual Sectors is the perfect answer to the when question. We help retail investors understand key trends in the market, and our data sets put a calendar date on them. We source the most complicated data from Standard & Poor's, FactSet, and Options Pricing Reporting Authority to turn them into easy-to-read charts with up to 72% win rate based on 10-year back test.